Alright, so I've been asked to talk a little bit about prudent valuations and AVA. So don't worry, I won't talk very long. This will be maybe 10-15 minutes at most. So the actual work I'll describe is actually quite old. We did that back in the day, maybe 5 years ago, in the context of high-frequency trading. So in high-frequency trading, obviously you have to close out any positions overnight. So there it was pretty interesting to estimate the likely closeout value of any large-ish position. So when we first did that work, it was pretty niche. However, now it's becoming quite a bit more interesting from the regulatory standpoint, especially with the new requirements to do with prudent valuations and AVA. So to motivate this work, let me bring out an example. So my example is the 2008 Société Générale trading laws. So for those of you who spent last 10 years on Mars, what happened to Société Générale? Well, a junior trader called Jérôme Kerviel had put up around 50 billion euro worth of unauthorized trades on behalf of his employer, Société Générale. SocGen discovered these positions on the 19th of January 2008, and they traded out of them over the course of 3 days. So this is the P&L figure that they published, the P&L of Jérôme Kerviel's positions. So there's something pretty interesting going on here. If you have a look at when Jérôme Kerviel was actually discovered, he was making money. He was about 1.5 billion euro in the money. 3 days later, when SocGen had traded out of these 50 billion euro worth of position, suddenly the P&L was minus 5 billion euro. In other words, they lost around 6.5 billion euro just on trading out of these positions. So whatever went wrong here, well, maybe this whole assumption that the positions were initially worth 1.5 billion euro was incorrect, because clearly by the time they traded out of them, they were worth nothing like that. Or maybe there was something wrong about their trading methods, so they managed to move the market against them so much that they actually made such a big loss out of a winning position. But no matter what happened, there's obviously this big discrepancy between the values of this position just when the positions were discovered and at the end when they were traded out of. The second example I'll put up is the flash crash of 6th of May 2010. So again, for those of you who never heard of this, what happened on the 6th of May 2010 was the markets had opened pretty low. They had been trending down all day, and at one point, at 2:42 p.m. to be more precise, the equity markets, the US equity markets began to fall rapidly, and the Dow index lost almost 1,000 points on the day's open by 2:47 p.m. In the next 20 minutes, the markets had recovered and they had regained almost 600 points of this drop inside 20 to 25 minutes. So this is the graph of some of the relevant markets, and here we can see as the markets crashed and recovered, the volume spiked quite significantly to about 4 or 5 times, if not more than that. Of the actual expected trading volume. So when this first happened, there were all sorts of accusations flying around: who caused what, whose fault was what, and the accusations were becoming increasingly shrill. People were generally blaming high-frequency traders and the likes. Once the emotions had cooled off, the most likely culprit appeared to have been a mutual fund who had started a program to sell 75,000 E-mini S&P 500 contracts. Now the total value of these contracts was about 4.1 billion, so what happened, or what most likely happened, was as the market was trading down, this big sell pushed the market down a bit further, as big sells do. Then this triggered stop losses in some of the long-only positions, so some long investors then started selling their positions because their stop losses had been breached. Their sell-offs had pushed the market even further down. They had triggered new stop losses of other investors who then joined the sell-off, etc., etc., etc. And then finally the market makers and the high-frequency traders saw that the market was so out of line with the fundamental values that they started buying it back, and that's what led to the recovery. So this is probably not immediately relevant. However, the relevance here is the actual onset of the crash. So this is again a slightly large position which somebody tried to close out, and in closing out their position they managed to move the market way beyond what they presumably expected was going to happen. So these large positions really are strange. We are almost talking about an uncertainty principle of finance, and here I'm drawing a parallel with the uncertainty principle in quantum physics. So you may recall that in quantum physics, for small particles, if we try to measure their positions, we destroy their momentum. So in the slightly stretched analogy here, in finance, if we try to realize the value of a large enough position, we will destroy the market, as evidenced by these two examples. Now, it's obviously not a 100% analogy, however it is close enough. So in the same way that in quantum physics there's a fundamental barrier to how accurately we can measure the position and the momentum of a particle, so in the same way in finance there is a fundamental barrier as to how finely we can estimate the likely closeout value of a large position. In other words, we cannot really value large positions accurately. Now, if we try to value a large position naively, so we might want to say something like, say, 10 million shares of IBM is worth whatever the market price is of one share of IBM times 10 million, that's obviously completely meaningless. The actual value of 10 million shares of IBM is however much cash we can raise by selling those shares. So this is something that the regulators have woken up as of recent. So in particular, we're talking about the Capital Requirements Directive number 3, which imposes the principle of prudence upon the pricing of financial instruments which are recognized at fair value. So now we have this concept of a prudent value, so that's fair value minus some risk and cost factors. And these risk and cost factors are related to the likely cost of closing out the position. So for a small position, say one share which we can close out at market, then obviously this adjustment will be small to zero. But in terms of large positions, where the likely closeout cost is large, then this adjustment will be significant. So this is so-called AVA, or additional valuation adjustment. Why additional? Well, because we're already making adjustments for counterparty value adjustment, dealer value adjustment, etc. So apart from CRD 3, there's also the Capital Requirements Regulation, Article 34, which requires the application of prudent adjustments to be made to all fair value assets, including those in the banking book. So not just to the trading book assets, not just to liquid trading book assets, but to any single asset that we might have to value. Alright, so where does that leave us? How can we calculate this additional valuation adjustment? So the additional valuation adjustment, again, is the adjustment we should be applying to the fair value of investments in order to account for the likely cost of closing out the positions. So this should obviously include our own impact on the rest of the market, because, well, that's precisely what happened in the case of SocGen and the flash crash. What actually moved the market was the impact of these particular positions being closed. So obviously we will always know what the cost of closing out position was once we've closed it, but that's not very helpful, because once we've closed out the position, then there's no valuation to be left. What we'd really like to do is we'd like to be able to estimate this before we've closed it out. What the regulator requires is a 90% confidence estimate. So what that basically means is, if we have, say, 10 positions, 9 out of these 10 should come inside our estimated prudent value once they've been closed out. So it's actually a pretty high margin on a number which is as fuzzy as the number that we're dealing with. So what's the basic problem here? Well, the basic problem is that estimating market impact is a bit of black magic. If we trade too much too fast in some abstract way, then obviously we can destroy the entire market, and that was evidenced by SocGen 2008, it was evidenced by Flash Crash 2010, and it was evidenced numerous other times in the past. So what is the appropriate rate at which we should trade out of positions? It's not a very easy question to answer, right? Because if we put ourselves into the shoes of, say, SocGen in January 2008, they knew they had 50 billion worth of positions to close out. They had calculated that, well, yes, they could close them out slowly over a couple of months, but they thought that it would be impossible to keep such a big position a secret. They thought the information would surely leak out into the market, and once the information had leaked out, it would already impact the market. And then once they came to trade it, the impact would have been much worse than it would have been by simply trading out of it immediately. In terms of the flash crash, I mean, these 75,000 contracts which triggered the crash, it sounds like a lot, but actually this was only 1.3% of the total E-mini S&P 500 volume on that particular day. So on that particular day, it traded 5.7 million contracts. And during the period in which the orders were executed, this accounted for less than 9% of the market. So it's a considerable percentage of volume, but not unheard of. I mean, people execute 10% of the market or higher than 10% of the market every day, and they do not cause the markets to crash. So actually in both of these cases, the trading tactics seemed quite reasonable at the time. I mean, it's not like these guys were cowboys who did something and they said, well, the hell with the consequences, we'll just do something, and then they woke up to these unintended consequences. They did presumably do a fairly rational analysis, and what they did seemed quite reasonable at the time. However, it obviously turned out so wrong. So one question that we probably want to answer is, why did it turn out so wrong in both of these cases? What could we do differently today, and what should we do? So before we start answering that question, we should probably review why trading creates impact. So what's here is a fairly standard diagram of a limit order trading book. So I just picked this up from Google. So what this shows is how a price is formed in a limit order book. So on the left side, black blocks represent buy orders. On the right hand side, the gray blocks represent sell orders. So these are all limit orders, so they're all orders to sell or buy a certain quantity at a certain price. So those limit orders which are not immediately cancelled, which are not filled, are deposited in the order book. So there's some order book being filled on the bid side, there's some order book also being filled on the ask side, and then that forms the price. So then we have the best bid, so this will be the highest of these resting bids. We have the best ask, so this will be the lowest of these resting asks. We have the mid price, which is the halfway in between them, etc. So now what happens when there's a trade? Well, here we have an example of an aggressive sell. So we see a gray order crossing the spread. So somebody has decided to sell and has decided to take out liquidity from the bid side of the order book. So in other words, when they traded, they've taken out volume of the order book, and that has some price impact. Now, it may not have moved the actual bid because it may not have exhausted the total volume at the best bid. However, it will have removed some of the volume from this best bid, and that will have triggered some of the other buyers to behave in a different way. They might push back, they might push forward, depending on whatever their trading tactics is in such scenarios. It's not that only aggressive trading creates impact. If this guy had just decided to sell passively, so in other words, if he just added his liquidity to the ask side of the order book, he probably would have increased volume on the best ask. Then the guys who are queuing up behind him would have seen that they're much further behind in the queue than they were initially, and they might see that now their probability of fill has decreased, and they might decide to move more aggressive, so maybe to introduce a new best bid, the new best ask, and again to move the market in that way. So basically every time a trade happens, there is some impact. Now if a trade is very small, then the impact will be very small, but if the trade is large, the impact will be large, and the impact will in some way be dependent on the size of the volume being executed. So when we trade, we either destroy a part of the order book or we change the shape of the order book. So no matter what we do, we have some price impact. We move the price in some way. Now if we take volume out of the order book, that's fine. Obviously other traders will come back to replenish the order book. However, if we're trading too fast, we'll be destroying the order book faster than the other traders can replenish it, and obviously we'll be moving the market a lot. Also, if we sell too much, we may fill all the interested buyers, and then when all of the interest has been filled, then they may not come back to buy more. So, in other words, it's not just the rate at which we're trading, it's not just that we're providing this volume faster than the market can clear it, but it's also if we've actually filled all the interested buyers, there will be no more buyers left, and then the market will be empty on the bid side. On the other hand, if we're trading very slowly, then the market will be moving in its own right, as markets do. So if we trade too slowly, then obviously we will be minimizing our own impact. However, then we will be exposed to the volatility of the market. The market might, in its own right, move anywhere, and we will have absolutely no idea what price we might get the longer our trading takes. So obviously in a regulated markets environment, we are under some constraints when we're trading. So for example, under MiFID, we have an obligation to deliver best execution to our clients. Now, best execution is a fairly vague concept, and it is up to individual institutions to interpret this. It can be interpreted to mean best price. So if we're trying to get the best price, then what we're trying to do is we're trying to minimize the adverse market impact. And as we've just seen, the market impact depends on how quickly we trade. So if we're trying to execute for best price under MiFID, then we are under some obligation to not trade too fast, in other words, to trade slowly. However, another interpretation of best execution might be high certainty of fill, and that might be the case if the client is not all that price sensitive. However, they need to close out a position for whatever reason. So if we're trying to give them the high certainty of fill, then we're trying to minimize the time they spend in the market trying to close this out. In other words, then we actually want to trade fast, because now we're more concerned with the certainty of fill than the actual price we get by filling. Apart from client obligations, we also have some obligations under the FCA Code of Market Conduct. So for example, we have obligations to contribute to orderly functioning of the markets and not create undue impact. So that in its own right clearly prevents us from doing anything that would, say, wipe out the order book. So let's say if we had a big position to fill, we could theoretically just wipe out the entire order book with our position. However, that would fall foul of our obligations to the FCA under the Code of Market Conduct. So, practically speaking, what does this look like? So, here we've drawn some diagrams. So the line in blue shows us the price evolution of a particular security without us trading. And the red line shows us that same evolution with us trading. So obviously us selling this is creating some impact. Now the green line will show us our remaining position. So what we see is obviously we started with, let's say, 100% of the position, and then the longer the passes, the more we're trading, the smaller position remains. So what this shows us is that actually, even though our trading is creating market impact, now obviously as our own open position reduces in size, the less impacted we are ourselves by our own market impact. Because now the new price that we've moved the market to will only apply to our remaining quantity. And if our remaining quantity is only a small percentage of our initial quantity, we will find that actually our own market impact is not having a big effect on the price that we ourselves get for our securities. So if we're talking about retail size, so what we're plotting here is the variance of the P&L as a function of the trading rate. So if it's a small position, so what we call a retail size position, we see a graph like this. So if we're trading very slowly, if our trading rate is close to zero, we're spending a long time in the market, and then we're exposed to whatever variance the market might experience in that time. On the other hand, if we trade very fast, then obviously we will inject some volatility in the market. We'll have our adverse impact. However, for a small retail size position, this impact is limited. On the other hand, if our position is large, if it's of institutional size, then it's more like this green graph here. So again, we have let's say a tactic where we're trading very slowly. So if we're trading very slowly, we're obviously minimizing our impact. However, it takes us a long time to trade out of this, and then we're exposed to too much market volatility. On the other hand, if we trade a large position too fast, our impact can be enormous. And here, basically, we can cause a flash crash all of our own. So if we trade too fast, it will go wrong because our impact is too high. So somewhere in between those trading rates, there's an optimal trading rate which minimizes our uncertainty over the P&L. And that rate is our candidate for a good rate to trade out at. Because if we, there's basically multiple things we could be optimizing for. So if we're trying to optimize for the price we get, we're basically trying to minimize our impact, and then we're on the left side of this graph. However, then we're exposing ourselves to too much uncertainty. If we're trying to get out of this uncertainty by trading fast, then we might trigger an avalanche in the market, we might destroy the market, cause a flash crash, and again, we do the exact opposite of what we're trying to do. So the reality is the only criterion which seems to satisfy what we would intuitively consider to be reasonable trading will be this intermediate trade where we're trying to minimize the uncertainty in our P&L. So the added bonus with that is that this will give us the highest confidence AVA number, because our own AVA obviously will need to estimate some distribution of the prices we might effectively recover for our positions. So the number where this distribution is the tightest will be the number where it is the easiest to estimate the 90% confidence interval as we have to under the regulations. Alright, so what's the bottom line? Well, the bottom line is for retail sizes we probably shouldn't try to be too clever. If we try to trade too slowly, obviously that will be bad because we'll be exposing ourselves to too much market volatility. In terms of trading, we should just take them all out in one go. That will create adverse impact, however that impact will be limited. So then in terms of prudential valuation, the prudent value of a retail size position is its fair value minus its immediate order book impact. In other words, we count how many shares we'll take out of the order book by trading our positions, and we see what the best bid will be, we see what the market mid price will be, and that will be our prudent value. In terms of institutional sizes, it gets more interesting, because trading too slow is bad for the same reason that trading too slow is bad for retail positions, but now trading too fast is bad because by trading an institutional size position too fast, we can wipe out the market and inject too much volatility. So now in terms of trading, we're looking for this trading rate which will minimize the uncertainty over our realized P&L. And that optimal trade is now the basis on which we can estimate the prudent value and the additional valuation adjustment. Alright, thanks very much. I'm ready to take some questions.